ツマンおじ今日のニュースを読みましょう。Reuters Fed signal pause on the rate cut as investors navigate data darkness and leadership changes. Summary: Fed's pause contrasts with market expectation for the future rate cut. Economic data gaps due to government shutdown affect the policy outlook. Investors advised to stay the course amid financial noise and uncertainty. After 3 consecutive interest rate cuts, investors now confront an uncertain U.S. monetary policy outlook for the years ahead, clouded by persistent inflation, data gaps, and impending leadership changes in the Federal Reserve. The U.S. Federal Reserve cut interest rates by the 0.25% point on the Wednesday in an uncommonly divided vote, but signaled it would likely pause further reductions in the borrowing cost as officials look for clear signals about the direction of job market and inflation that remains somewhat elevated. The Fed projection for the slower easing path contrasts with the market expectations for the 0.25% cuts in 2026, which would bring the Fed funds rate to about 3.0%. Policymakers see only one cut next year and one in 2027. Wednesday cuts brought the policy rate to the range of 3.50% to 3.75%. The central bank's updated projection showed 6 policymakers preferring no rate cut this year, and 7 anticipate no further cuts in 2026. How monetary policy evolved from here will hinge on economic data that is still lagging from the impact of the 43 days federal government shutdown in October and November. This comes as the U.S. heads into the midterm election years, likely to focus on economic performance, with President Donald Trump urging sharp rate reduction. I think the guessing game of what the Fed does next is going to be getting a lot more difficult next year, said Art Hogan, chief market strategist at B. Riley Wealth. Fed faces a delicate balancing act. Investors face the uncertainty of next year's monetary policy as inflation trends and labor market strength remain unclear. The Fed's dual mandate, employment and price stability, is fueling internal debate at the Fed. To me, it just showed you the fine line the Fed is operating in, the fine line the economy is operating in, or I refer to it more as a delicate balance, said Brent Schutt, the chief investment officer at the Northwestern Mutual Wealth Management Company. It's highly unknowable where we are headed in the next 6 to 9 months, just given all the changes that are out there in this historically kind of odd period where you have tensions on both sides of their mandate. The flow of economic data should gradually normalize after recent government shutdown, but uncertainty remains. The Fed guidance probably tells us the less than usual about the interest rate outlook for 2 big reasons. Bill Adams, chief economist for the Comerica Bank, said in a note. First, they know less than usual about the current rate of the economy because the shutdown delayed the release of economic statistics. Second, the Fed guidance does not account for how its approach will change after Chair Powell's term ends in May, he said. White House economy advisor Kevin Hassett, seen as front-runner to be the next Fed chair, told the Wall Street Journal CEO Council on Tuesday. There is plenty of room to cut interest rates further, though a rise in inflation could change the view. Trump said on Wednesday that the Federal Reserve interest rate cut was small and that it could have been larger. This one just feels to me, at least looking forward into 2026, that there are still lots of unanswered questions that are out there that pertain to the direction of the economy and the direction of interest rates in the future, Schultz said. Ignore the noise. For some investors, wisest move is to stay the course and avoid knee-jerk reaction. You are about to get awful lots of financial noise between now and the end of next year, and said Alex Morris, Chief Investment Officer at the FM Investment. While investors may still have to grapple with the possibility of better than expected growth or higher inflation in the year ahead, those scenarios were seen as unlikely to trigger a tightening in monetary policy, he said. It's not so much that you need to be so worried that you should duck and cover, said Maurice, who has been advocating for bond investors to extend the duration. Powell on Wednesday said the Fed's next move is unlikely to be a rate hike, given that is not the base case reflected in new projections from the central bank policymakers. Meanwhile, stock market investors don't appear too worried about the prospect of the pause in the rate cut. While lower rates have helped lift the stocks to new highs, further easing, especially if driven by economic deterioration, may be unwelcome. I hope there aren't rate cuts in 26 because that will mean economy is weakening. I'd rather have a solid economy and no more cuts, Chris Crescenti, a chip market strategist, MAI Capital Management, said. 終わり。